Okay, so we've just gone through the European cash equity close, so I just thought I'd give a quick wrap up of the day. There's obviously been quite a few things been going on. In particular, we had a little bit of early selling pressure in the US equity space before we've seen a bit of recovery over the last 10 or 15 minutes. Now, in particular, I just want to quickly show you the S&P 500. Obviously, from a technical point of view, from the earlier test at that level, which was the same price point roughly of around where we had that big sell-off in the latter point of Tuesday's session. This was, of course, triggered by a sell-off in a tech space, which, as we covered in the briefing this morning, saw the FANG stocks fall about 6%. The NYSE FANG Plus index was down about just shy of 6% yesterday. It was the biggest rout in that specific indicator going back to September 2014. So tech names again have remained particularly weak, and although we have seen a bit of a bounce, before I get to looking at the tech names today, who is the weakest one, just wanted to also have a look at this 200-day moving average, which undoubtedly people will be talking about in press tomorrow, because we've got very close to that point again before seeing a little bit of a bounce off those lower levels. But you can see really going back to all the way from when Trump won the US election, which is the extremity of that candlestick there. You can see that big spike. That was the night of the election itself. But then we've rallied ever since, when we've had a test at the 200 DMA, but consequently didn't break. And that's happened again in the earlier part of March, bounce. So it's quite a key level that a lot of equity players have got half an eye on. Looking at that more near term, obviously we have stabilized since, but looking at equities quickly, this is the heat map. There's one company in particular getting really hammered today, and this time attention has moved from Facebook, which actually is marginally positive, only about 0.1%. But if you look at Amazon shares are down 6% today. I mean 7%, excuse me. I mean, that's huge for a company of that magnitude. We are talking about one of the largest, if not the largest, company by market capitalization in the world. Now, why is that happening? Well, this is the press report that people are looking at, and Amazon has lost nearly $40 billion in market cap today alone on reports from Donald Trump wants to go after the company in regards to tax. So according to insiders, Donald Trump is obsessed about going after Amazon. Trump has discussed altering the company's tax treatment because several of his friends told him Amazon is hurting their businesses and killing shopping malls and brick-and-mortar retailers. So, yeah, if Trump's got it in for you, you've got trouble, because this is the regulatory impact is quite frightening on how quickly you can see this play out in market activity. And as I say, Amazon down sharply. You know, I was talking to Will, some of the other trainees earlier, about the tech weakness. Don't forget who Trump is trying to appease here from a political point of view. It's the Rust Belt, and it's the manufacturers that he really wants to get on side in regards to his voting electorate who support him the most. Hence the tariffs, the America First policy, which has been more beneficial for those US related aluminium and steel firms, for example. Whereas if you look at something else like technology, well then technology is based in the state of California, and California is undoubtedly the most democratic area of the entire of the United States. Also, as well, the composition of the workforce of a technology firm like Alphabet, Google, Facebook, LinkedIn, Amazon tends to be more of an immigration, or more immigrants work within the workforce there than they would do traditionally in a steel company, let's say, like US Steel, for example. And so, again, politically, you can see why they would target, or Trump and the administration would target technology in particular. And obviously, given those reasons that I mentioned earlier this morning, there's been some quite negative news flow for the likes of Facebook with this ongoing privacy scandal. You've had Tesla probes into a recent car crash that happened with their technology being in question and investigated. And so, you know, these what have been very high multiple earning stocks which outperformed last year due to the outperformance are also subject to big pullbacks in that respect. And so, just explaining some of the movement and the focus on this tech move that we've been seeing. Okay, quick look at some other things. I just wanted to bring the FTSE into shot. This is the FTSE CFD, which I know some of the guys trade. I just had it marked up because here is a headline that broke earlier today, and that was Shire takeover headline. This was done, as you can see, very quickly, so you have to excuse the typos in takeover, 2 words, and headline. But the point being is that the catalyst there was the Shire headline, and we kind of rallied ever since when it came to the FTSE. Now the pound has also weakened, more pressed lower in cable by a strengthening or recovering dollar, with the dollar index up about 0.5% today. And so the FTSE has managed to get its head above technically that level, the high point that we saw in yesterday's session. But the headline reading came from Shire, which has been up, at one point was up, I think, over 20%. This has come after Japan's Takeda Pharmaceutical Company was considering a takeover bid for Shire. Now, Shire's market cap, to give you an idea, they are one of the larger FTSE 100 companies, approximately about 30 billion sterling, I think is their market cap. So this is obviously a big M&A deal, and their shares benefiting sharply on the back of that talk. So that was the FTSE situation. The FX situation has been one of dollar strength. So although we've had a bit of volatility in the equity space, we've continued to see the dollar recovery. That has been something we've been looking at this week, with a bit of a de-escalation on the trade war rhetoric coming out of the US administration, i.e. Treasury Secretary Mnuchin at the weekend. And that has weighed on both major currency pairs. So just having a quick look at cable on a slightly longer time frame. And obviously if we look at the 90-minute chart, this is one we've been looking at for the last couple of sessions, because this encapsulates kind of the big rally from last week. And you can see that some of the levels which we were looking at here that I've got circled is still playing out with some relevancy in today's session as well. Really, it's this key level, or this band here, that I'd be interested to see as a key level of support going forward. So kind of around that zone there. If we get a break of that, then we could see a bit of a more meaningful pullback down towards, if we break through the 141, then back down to 140.50 is then where technically that looks like quite a strong level. But so far, so good for that 141 kind of 30 to 23 level holding for the time being. But definitely one to watch. Pretty light on the Brexit front, no real fresh headlines since we covered that Times story which came out overnight talking about potentially a new resolution for the Irish border situation, but nothing's been forthcoming. Gold lower today, byproduct really of the dollar move. I guess if we start looking at gold on a longer time frame, Goldman's got even more egg on their face, I think, at this point. The move's doubled in size since they've recommended going long. As I said, almost the classic reverse indicator. We're off about 2.2% now from the high since that research note came out. Looking technically, yeah, we are coming back down to a fairly interesting level from around the resistance point that we printed back at on the 21st. That kind of area of support as well. So if we continue tracking lower for the rest of the US session, if the dollar keeps strengthening, then maybe that 13.32 might be a good level to just keep an eye on for a test. You can see just going further back on the time frames, it has played out as a fairly key level of support and previous resistance. Okay, finally, quick look at oil. That has seen some movement. Now, a lot of the newer live guys I know were almost teased into action on the back of this, but I can't stress enough how trading the oil inventory numbers is a very high risk strategy. Incredibly high volatility, inspired by the fact that the DOE oil inventory report is multifaceted, which means there can be conflicting numbers, and this was a real case in point of that happening. What you had was an initial spike higher. Why did that occur? Well, that's because the headline crude number was a build of 1.64 million, which was nowhere near the API print. So therefore it was a bullish signal for the market on the first input, that being the headline crude figure. The market went higher, but then subsequently turned quite aggressively, and we broke technically the low from earlier today, and also the low going back to the end of last week before the bigger rally that we had on Friday. And so another key reason to kind of not jump into the market too quickly, the point being to be a little bit more controlled, a little bit more disciplined, and obviously for you guys this will come in time, the better you get. But again, it's about consistency in that respect, so putting yourself in harm's way in great volatile situations like that, which is quite a complex piece of data to try and navigate, because the amount of information and US output, don't forget, I think it was up 26,000, so US output continuing to move higher, and subsequently the bigger move has been one lower. The price point where we found a bit of support here in oil does look quite interesting. This is looks like that's the S1 level on the day, which is also the 64 handle. So what I'm looking at really is where we are at the moment, just there. So you got the 64 handle, you got S1, and then you've got that previous area of resistance and support. So it'd be interesting to see how it reacts at around this level. All right, quick look at the calendar for tomorrow. But before I do that, just in terms of economic data we did have today, a couple things. The final reading of Q4 GDP in the US was revised slightly higher. It was at the top end of the analyst expected range. This is what it looked like. So Q4 now finishes at 2.9%. That was no real shock to the market. This is fairly old data now, and it's consistent with the previous three prints that we've had. PCE data, likewise, no real surprises, no reaction to the trade balance numbers. Looking ahead to tomorrow, though, what have we got? Well, this is the last day, of course, before Good Friday and the global market closures. So we've got the end of month and quarter end. So you need to be aware of those respective flows that could impact the market accordingly. First thing tomorrow, you're going to get the first of the German state CPIs. You've got the state of Saxony at 8. You'll then get all the other ones coming in. 9 is Bavaria and Hesse, all the way culminating into the 1 PM release of the national or the pan-German CPI release. Remember, usually it's the first state CPIs which give the market the signal as to the inflationary conditions for the whole of Germany, given it's the first little snippet of information that you get, and most of the German regional states tend to mimic one another. So the first ones that come out are usually the most important. You've also got German unemployment update situation at 9 o'clock. Going forward, UK mortgage approvals, I don't really think that's going to have an impact on the pound. The Q4 GDP from the UK is also the final reading, so it's kind of the same drill with the US numbers we had today. Pressing on into the US afternoon, you then get personal income spending, core PCE data. Now that is a little bit more interesting. Obviously, we are still inflationary focused. Core PCE is one of the Fed's preferred measures, and if you think about it, the market's gone through quite a change and shift in sentiment about its forward-looking expectations in monetary policy. We've gone from a panic about extreme monetary tightening to now almost the opposite, because inflation numbers haven't really lived up to the hyped expectations which were prevalent in early February, which caused that short-term stock market correction. So the PCE data will be interesting. Weekly jobless data and some Canadian numbers, GDP, producer prices. This is more relevant specifically for the CAD, the loonie. Then you've got the Michigan number, but again, this is final data. Speaker-wise, and really not a great deal. So that's it for today. We'll obviously have the morning briefing as per usual tomorrow morning, so have yourself a good evening. Just to finish off, crude has broken that level, so you can see the significance there. The price was holding up at that level, and now it's broken lower. You've got a bit of a further extension of that selling pressure. On the downside, I'd probably be looking at 63.58 as the next level of support. All right, guys, good night.